Everyone said Bitcoin would protect investors in times of stress. But this week proved the opposite. $500 billion gone. In less than a week, almost half a trillion dollars just disappeared. And I'm not talking about opinions or tweets, I'm talking about real market value that wiped out. Bitcoin, Ethereum, everything is in red. Bitcoin alone has dropped below $73,000, which is its lowest level since before the US election cycle hype really kicked in. And if we zoom out for a second, that's important because not long ago the narrative was completely different. There was a time when crypto was riding on confident, crypto friendly policies, a future where Bitcoin was supposed to thrive as an alternative system. At its peak, Bitcoin was trading well above $120,000. Fast forward to now, it's down nearly 40% from the top and already double-digit losses this year alone. So the real question is not did crypto crash? The real question is why did confidence break this fast? And one of the first things to understand is risk. Right now, global risk is rising everywhere. Geopolitical tensions are heating up, especially between major powers. Markets don't like uncertainty, and when uncertainty rises, money moves. Traditionally, money runs towards safety, gold, silver, assets people trust when things get uncomfortable. A lot of crypto believers thought Bitcoin could behave the same way like digital gold, but that didn't happen. Gold recovered, Bitcoin didn't. Instead, Bitcoin fell alongside stocks, not against them. And that tells us something very important, whether people like it or not. In moments of stress, the market is still treating Bitcoin as a risk asset, not a safe haven. And that's a problem for the narrative. But fear alone didn't cause the sell-off. What really accelerated the crash was leverage. On a single day, more than $2.5 billion worth of Bitcoin positions were forcibly liquidated. That means traders who borrowed money to buy crypto were pushed out of their positions when prices dropped. Forced selling creates more selling pushes prices lower, and lower prices trigger more liquidation. It becomes a loop, and once that loop starts, it's brutal. At the same time, the broader economic backdrop isn't helping. Trade tensions are rising, the job market is uncertain, and investors are unsure about where interest rates are headed next. Crypto performs best when money is cheap. Right now, money isn't cheap. On top of that, the Federal Reserve outlook has become more uncomfortable for market. The expectation of tighter policy or even just higher for longer is enough to pressure speculative assets. Some well-known investors are now openly saying something that would have been unthinkable during the bull run. Bitcoin failed its stress test. It didn't protect, it didn't hedge, it didn't behave independently. So where does that leave us? Right now, confidence is shaken. Some believe prices can stabilize if things don't get much worse. Other thinks this market needs clarity, real clarity before buyers step back in. And this is where it gets really interesting because this sell-off isn't just about fear or leverage, it's about something not behaving the way it's supposed to. The usual playbook isn't working. The recovery isn't showing up where people expected it to. And when that happens in market, it usually means one of two things. Either we are early in something most people don't understand yet, or the cycle people think they are in is already over, and that's why this entire crypto cycle feels off. Not broken in an obvious way, not collapsing the way past peer market did. Think about what we have already lived through. We have had one of the biggest liquidation events in crypto history. Tens of billions erased almost instantly. The excuse was easy: tariffs, politics, risk of headlines. Market panicked, crypto dumped. End of story. Except that wasn't the end of the story, because traditional markets recovered, volatility cooled, stocks stabilized, crypto didn't. And that's where the real question starts. Is this just another phase or a structural shift? If this were a normal bull cycle, we should have seen a clear blow off top. Retail euphoria, everyone calling for insane price targets, altcoin going vertical, and that didn't happen. A lot of retail never fully showed up. Many altcoins never made new highs, yet at the same time, something strange was happening behind the scene. Let's list the contradiction. Spot Bitcoin ETFs approved, institutional grade products launched, future markets expanded. Banks offering Bitcoin-backed loans, portfolio models including crypto, stablecoin regulation passed. On paper, this should have been the cleanest, strongest bull run ever. So why does it feel like Bitcoin is constantly struggling to hold momentum? Because maybe we are measuring this cycle wrong. For years, crypto has leaned on one simple idea: the 4-year cycle. Halving happens, supply tightens, price explodes months later, and that pattern worked until now. This time, price action isn't following the script, timing is off, moves are muted, and overlays from past cycle just don't fit cleanly anymore. That's why some analysts are shifting focus away from halving charts and towards something bigger: global liquidity. When manufacturing credit condition and liquidity expand, risk assets usually follow, Bitcoin included. If that framework holds, what we are seeing might not be a bull market failure, but a reset inside a longer, slower expansion driven by institution. And that changes everything. Old indicators are not behaving the way they used to. Signals that once marked tops are now early or late or unclear. Models built on scarcity worked until liquidity, derivatives, and macro forces took over. Bitcoin stopped acting like a niche commodity, it started acting like a global macro asset. And macro assets don't move the way meme driven markets do. The biggest difference this time: institutions. They are not coming, they are already here. ETFs, pension adjacent exposure, banks, regulators openly discussing retirement access. This was supposed to be permanent capital. So why isn't price responding the way people expected? One uncomfortable theory is that institutions don't chase price. They wait for clarity, clear rules, clear custody, clear compliance. That's why regulation might not be the spark, it might be the permission, not the ignition, but the green light. And if that's true, then future cycles won't look like the past ones at all. Diminishing returns, longer timelines, every cycle so far has delivered smaller gains than the one before it. Volatility has dropped, drawdowns may be less violent over time, and that doesn't mean Bitcoin is weaker, it means it's maturing. And mature assets don't explode overnight, they grind, consolidate, and reprice slowly, which leads to the uncomfortable fork in the road. Either we are early in a longer institution led cycle, or we are already in a bear market. And here's the irony, both scenarios reward discipline, not emotion. Because markets don't pay people for excitement, they pay people for patience. And if this really is a transition phase, then the biggest mistake isn't being wrong, it's reacting emotionally to a market that's changing its rules.